Hello, everyone, and a very warm welcome to today's Major Markets Update for Friday, August the 23rd, 2024. As you know, we have some new slides to make it all look slick and nice and easy. But as you know, trading the stock markets is never easy. However, we stick to our proven concept of the Elliott wave theory, and we have most likely finished this smaller wave 4 and are on our way for this smaller wave 5 to complete a larger third wave, contingent, of course, on holding above certain key price levels. That always remains the case. Why do we say that? Because we are wrong until proven right. We anticipate, we monitor and adjust. And with that, we manage our risk. Nothing matters in the stock market more than managing your risk. Bulls get slaughtered and pigs get slaughtered. But those that manage their risk, the prudent ones, will fight to make it another day. So remember that we always want to know exactly what's going on, but there are simply times when things are unclear. And yes, I'm going to repeat these slides quite often during my presentation because we do have new members that join, and they do also, of course, need to hear this and, of course, read this. So what we do, we anticipate, monitor, and adjust based on the best analysis method there is available for the stock market, the Elliott wave. And there is no difference here with medical healthcare. You assess the patient's needs, you plan on what to do about it, you carry out the intervention, you evaluate the effectiveness of the intervention, and if necessary, if the intervention is not good enough, you try something else, for example, up the dose on a medication you gave. And we only intervene, of course, when there's a rationale for it. And the rationale needs to follow a scientific evidence-based process. So when the evidence changes, we change accordingly. When the charts change, we change accordingly. And that's why we have those warning levels on the charts. If we, for example, have a bearish wave count and then market starts to rally and cuts through certain price levels, we know, of course, that that bearish wave count at some point will get invalidated, because the beauty of the Elliott wave is that it is price-based. And the only thing that pays is price in the stock market. So you don't need to analyze anything else but price for your trading. So I don't need to know what Powell says or Powell does or anything of it, okay? All I need to know is price breaking above or below certain price levels to tell me that the wave count we are tracking is still right, or if it has been invalidated. That's all there is to it, quite simple. So you can then make life more complicated, for example, using Jesse Livermore's 21 trading rules. I'm not saying you should not. For example, he says never average losses, and you should not. And you should also be very aware of the speculative environment you're in. And as long as the stock market is acting right and the market is acting right, it does not hurt to stick with your position. It does not hurt to stick with your analysis, because markets are never wrong. Your opinion always is. And then, of course, we have our stop losses. Stop losses are extremely important. Those are the ones that keep us in the game because they save our ammunition. And we will get stopped out once in a while, and we will take losing trades once in a while. Just like a world champion and can never win all races. It's impossible. You can become a world champion by losing a few. Remember, you lose a few battles to win the war. So it's okay, take those losses on the chin, but keep them small. And if you can't deal with those losses, trading is either not for you, or you should trade smaller, less aggressive. Never ever use any leverage, in my humble opinion, because that can easily blow up your account when you get margin calls. And always make sure you don't put all your nest eggs in one basket. Always make sure to diversify, meaning that any position should probably not be bigger than an X percentage of your portfolio. Okay, that way that if that position gets stopped out, you still have plenty of ammo left to give it another try. And if it's still too much to ask for you mentally and physically, then please stop trading. Okay, you don't have to trade, not at all, but it is, if it goes well, one of the most rewarding and successful professions that you can do. And it can make you very happy. And make sure to always have a positive mindset and a good physique, because all of it plays a role in your decision making process and stick to the process. Okay, that is key important. And if you still need help, for example, my ETF trading alert service is a fantastic service that can help you get acquainted with how to actually trade. It tells you when to buy, when to sell, where to place stops, when to take partial profits, how to raise stops. It is the perfect way of trading. Yes, there will be losing trades. There will also be many winning trades. Our short-term ETF trading system for the NASDAQ 100 is, I believe, up almost 20% for the year. That might not sound like much, but again, there are a few losing trades, of course, that will lower the average. And this is not about beating the index versus a buy and hold. What this does is for you to have confidence in your trading, knowing that the system will support your trading and that you will not completely blow up your account. And I really don't care if you underperform or overperform the market. Of course, you want to overperform, but that's really difficult. In a bull market, most of the time, the market will outperform you. It is in a bear market where it will start to outperform a index, and then hopefully that will carry through in the next bull. But it's very hard to outperform bull markets, because even in bull markets, there are points where you get stopped out, and then 2-3 days later, the market continues higher and you haven't entered the trade yet. So it happens. That's fine. Don't look at what others do. Don't look at what the stock market does. Make sure you simply follow your trades and your process. And once again, the ETF trading alerts is fantastic to do that. Okay, that is a very easy way to go about. So let's have a look at the charts and see where we are. I don't have too much new to say compared to yesterday's update. So this is the Dow Jones first chart, and I think we'll just keep it as is. Maybe we're going to raise the stop levels a little bit. Today's low should hold. Okay, then we want to hold, of course, yesterday's low, and the rest should remain the same for now. That we have either this 4 or 5 left in green with gray wave 5 underway, or we are still in let's see here, that's 3, 4, and 5. Or we are already in all of green wave 5. I cannot confidently say which one it is, though I prefer the first one if I am forced to do so. But then we had, of course, wave 3 here, I believe, on Monday, and on Tuesday, Wednesday was part of this wave 4, and then yesterday's open and rally higher at the open was then the finalization of this gray wave 5, and then the rest of the day was green wave 4, and now in this green wave 5. Possible. Okay, very possible. Though I prefer this one, honestly, to set us up with more negative divergence. And I'm now looking here for about 41,400 to 41,600 for a potential top. Can always extend, but we'll take it day by day. We're looking higher, contingent on holding above the warning levels. And as you can see, we're continuously raising those warning levels, which is bullish. So we remain bullish. Anybody who wants to short this market, sure, go ahead. But it wasn't from me, because you will never hear me say that, not in the current rally. So I have zero signs that the top is in place. We have broken below 0 warning levels. All we did was yesterday break below the first warning level, the radar lock. Well, if you're a good enough pilot, you probably can get rid of that radar lock from your enemy and turn things around and start chasing the enemy, which is what we did today. So here's then the NASDAQ. That one could still have topped out here. Today's candle was a bit inconclusive for this C wave right here at the upper end of the ideal retracement target zone, which is a 76.4% retrace. We can still go higher. We can go to 88.2. We can close this gap here at about 20,300. And yes, we can even make a new all-time high. So I have also here no indication that the top is in. We did close yesterday below the blue warning level. Today we're back above it. So we'll keep things as are. As you see, there's a lot of wiggle room for the bulls to finally tell us the low is in place. And honestly, from an hourly chart perspective, it would look better with another wave 5 on the smaller time frame to that 20,300 level to close the gap here for this wave 5, which means that yesterday wave 4 bottomed right here in the ideal wave 4 target zone. Again, pretty shallow. If the wave 3 goes here to the 176.4, 161.8, you expect 100%. But as I mentioned throughout the week to you in my emails, that in bull markets, the downside disappoint. So this was a pretty good low here. I personally went long at the close yesterday. A tiny position, just a quarter of a regular position. I'm not going to risk much. Once again, it's a risk. And sold it at the open, easy peasy. I waited 10 minutes, 15 minutes into it, and new Powell was on tap, so I left it there. And then again, I bought the dip here. So it's still a buy the dip environment, and everybody trades whatever way you want to, but from a intraday trading perspective, pretty nice. So the warning levels are on the map, and we'll let the market decide. I do prefer, honestly, a tag higher to close that gap, and then we'll see if that was all of wave B. This is then the semiconductors. Again, we have 3 waves up. This is not counting 1, 2, 3, 4, 5, not yet. Could be, but that this is 3 waves up on a bigger time frame. So we had 1, 2, and then this wave 3 consisted of 9 waves. Each corrective wave was a down day. 2, 4, 6, and then of course 8, and then yesterday's high was 9, and so that makes it 4. All right, 3, 4. So to be determined, we closed back above the first warning level. So that said, we have nothing to confirm that a low is in place. All right, let's move on to the S&P 500. One wave count has the potential for this wave 4 completed, and now in wave 5, just as I showed you for the Dow Jones, and that we're on our way to new all-time highs to complete this black wave 5. As you know, if we go back here in time, let's see here if I can find the chart. 1, 2, all the way back to the October 2022 low. 1, 2, 1, 2, 3, 4, 3, 4, and now in this wave 5. However, this wave 5 can always subdivide. This is only a wave 1 of 5, so the current rally could still be only wave 1 of 5. If we drop below the August 5th low, then of course that's not going to happen. Okay, so the warning levels are still on the chart. They're the same, and as you can see, yesterday we closed below the first one, and now we evaded that radar lock pretty hard by steering hard to the right, and here we are on a daily close well above it. And honestly, if you look at where the chart is above the 10, the 20, the 50, 200-day at the upper Bollinger Band, expanding, RSI5's pointing higher, MACD's pointing higher, nice strong money flow, 0 indications of top is in place, 0, no negative divergence, nothing. So here is then the shorter term chart where yesterday's correction could also be the gray wave 4, once again in the ideal target zone of this wave 4, because we did exceed the wave 3 at 161.8, just the slightest. So this should then be the wave 4, and now in wave 5 to ideally 57.15 plus or minus 25. Okay, that is the ideal, and the same here for the NASDAQ 100, as I mentioned, somewhere around 20,200 plus or minus 100. Just to circle back on that. Quickly, though, I think I mentioned it. And again, we can always extend. I cannot predict the future, but this is a logical next target based on the typical relationship between fifth waves and first waves, and as well as third waves. So that said, looking higher, contingent on holding above the warning levels. The first warning level for the bulls on this time frame is below today's low. The second one is below yesterday's low. The third one is then below the gap close that we had mid-August, this runaway gap. So for now, 0 indication that a top is in place. That's the other option here, that we do have a top in place, similar for that for the NASDAQ 100. We'll only deal with it if we start breaking lower below these critical warning levels. And I've raised the warning level for this wave count slightly to the gap up, not at the close before the gap up, just to make sure that we are not losing too much and get a very early warning signal. All right. But other than that, it's a possibility. It's just a potential. 0 indication that is the case. We've had 0 indication that top was in the place all week, and therefore remained bullish with the prudent cautions. Like I said yesterday, it's time to maybe start taking some profits. If you're still long, it's time to raise those stops, all those things. They're never wrong about it. Okay. Don't think you need to be 100% invested at the top and need to buy 100% of your everything you have at the bottom. No, scale in and scale out. That is much, much better. Most of the time I go like a quarter position or half a position. And when things start to go in my favor, I buy more, or I go, you know what, the wave count's still a bit unclear. There's no real clear breakout like today. I'll just stick with smaller size positions for now. And as long as I make money, I'm fine. I don't have to be a millionaire tomorrow. That whole idea of getting rich quick should not be in your mind. Trading is a marathon. It is not a sprint. Look at Warren Buffett. How old is he? In his 90s? How much does he have? Billions? You know, he made most of his money after he was 65. So just the last 20 to 30 years of his life, the last 20 to 30% of his life is when he made the real bucks. Okay. And you will not be able to beat that. Trust me. That'd be great if you could. But just to show you patience, build it up, build it up, build it up. That said, yes, we can still have this B wave. We can even become irregular. But once again, look at where we are on the chart, above the Ichimoku cloud, above the 50, the 10, the 20, all that good stuff. No surprise. We've been looking higher ever since August 7th. Did we extend? For sure we extended, but that's fine. We start off with a typical target zone for a typical retracement. And from there, we'll just move on to see if that target zone will be reached. And if it's exceeded, we could keep on going. That's fine. That's how you then take partial profits and raise your stops, all that good stuff. Everything's positive. We see yet no reasons to turn bearish, especially since we're above the third warning level for the bears. So the bears should be scared, not the bulls. It's a very common concept for most people thinking, oh, the market is going to crash at any time. History has shown markets mostly don't crash. Simple. That's all there is to it. Markets mostly don't crash. So here is the IWM, which of course rallied very nicely on the news. Finally, we already knew it because Powell didn't say anything new that we already did not know, so to say, that yeah, interest rates will go lower, which is good for small cap companies because they've been hurt a lot by these higher interest rates. So that makes their business more expensive for borrowing and all that stuff. Anyways, so we're still looking higher and can go to the 230s to 240s for this rally, contingent on holding above key warning levels. And we're going to erase those. So the first one is, of course, today's low. And then the second one will be somewhere around here, about 212. And the third one, I think we should then put here at that gap. And then the fourth one will keep the same. You know what? I'm going to raise it to here, there. These are the warning levels for the bulls. And so far, I think we have a nice potential target overlap somewhere around 235 to 245. Okay, so this is what we are looking for. Sorry, I deleted the wrong one. There we go. Let's look at market breadth. This is the bullish percent index for the NASDAQ 100. So far, so good. It went from pretty much below 30 to over 70. Very strong signal. This is a good signal, and I think we should expect continuation a bit. Look at the bullish percent index for the SP500. We didn't go below 30, but we got below 50 and then rallied back above it. Still looking strong. No signs of a top in place. The negative divergence that has been going through most of 2024 culminated, of course, in the August low, and now we seem to erase that one. So that negative divergence has been taken care of. Okay, that's pretty much the message we're getting. Look at the AD line. This is the NYSE advanced declining issues, new all-time highs. That's not bearish. End of story. Doesn't mean you can't correct from there, but longer term, that's not bearish. The McClellan oscillator for the S&P 500 today was again into the 70s. That's strength. That's not weakness. And as such, the summation index, which has already been on a buy since mid-August, remains on a buy as well. That's not bearish either. None of them can predict the top, but all of them say we have no bearish signals. Last but not least, the PMO buy all sell all indicator remains on a buy. Currently, it's topping out a little bit below the ideal topping zone. It did the same here in May. So there's no indication that that is bearish either. We have no sell signals. We have 0 sell signals, not from price, not from market breadth, nothing. So you should draw your own conclusions from that. My conclusion is that it's bullish until proven otherwise, which is breaks below price levels, because price is the final arbiter. It's your level 1. Everything else is secondary and helps determine if our assessment of the price action based on another wave is correct, yes or no. And then, of course, seasonality, nothing new here either. Still looking here for a high later, so early September, the first or the second week in September, somewhere around there. Okay, so currently we are here at August 23, and as you can see, there is still potential for more upside. Though next week, later of August, we could see some weakness, which could then, of course, align nicely with this wave 4, and then we get the final wave 5. Okay, so it's all possible if we want to align all that stuff early this week, later this week, and then into early September, something like that. So early this week, and then later this week, and then early September. And that's really all I have for today. Not too much new from yesterday, but I wanted to share everything with you orally, and hopefully you understand our points of view and what it takes for us to turn bearish and why we continue to be bullish. And so far, I think being bullish is the mindset and a position that has paid off the best. All right. With that, I wish you a wonderful weekend. Take care, trade safe, and we'll catch you all later next week.